Hi everyone, today we'll be going over accounts October-November 2021 paper 3-3 question number 2. This is structured paper 3 which consists 6 questions each of 25 marks and we have a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 2 is from section A, which is of financial accounting. So without any further delay, let's get started. FC Limited is a trading company. Its directors have a policy that the income gearing of the company should be no more than 25%. So basically, income gearing can also be known as interest coverage ratio. So the formula for income gearing is just going to be interest paid divided by the profit from operations. Times 100%. So we require this ratio to be no more than 25%. Alright, then for the first part of this question, we need to explain why a company might be concerned about its income gearing. So from the formula, we can see that income gearing basically shows us the proportion of interest paid from the profit from operations. So if the interest paid is too high, then the proportion will also be high, which is not a good thing for any company because higher the interest paid, the lower will be the profit for the year, right? So the company should definitely be concerned about its income gearing. Now we will write the reason down for the first part. So we can just term it as a high income gearing ratio or the interest coverage ratio would represent increased risk that a business will be unable to cover its interest payments. Because if profit from operations is slightly higher than interest paid, then it means that we'll only get a small proportion of profit from operations as our profit for the year, which is very concerning for any business because the main motive of any business is to get a higher profit for the year. So let's write it down. A high income gearing ratio would represent increased risk that a business would be unable to cover its interest payments. Alright, this concludes the first part. Now we can move to the second one. We are given additional information regarding the statement of financial position. Alright, then further information is provided that the debentures were issued in 2017 and are due for repayment in 2021, which means that debenture is our non-current liabilities. Then the profit for the year ending 31st December 2021 is expected to be 36,000. A dividend of 18,000 will be paid by the end of that year. Then the directors intend to buy and equip new premises on 1st January 2022 in order to expand the business. This will cost 100,000. It is expected to increase profit from operations in 2022 by 12%. Alright, then the company could finance this expansion by taking a long-term 10% bank loan on 1st January 2022. So basically the finance of this 100,000 should be done by taking a long-term 10% bank loan on 1st January 2022. Now let's have a look at our question. We need to calculate the maximum value of bank loan which the company could borrow whilst keeping to the policy on income gearing in 2022. So the policy on income gearing is that income gearing can be no more than 25%, which means that only 25% of profit from operations could be calculated as the interest payment or the finance cost for the particular year. And we are talking about the value of bank loan in the year 2022, which means that in order to maintain the income gearing in 2022, we first require the profit from operations for the year 2022. Again, let's have a look at the above information. What we know is that the profit from operations in 2022 is increased by 12% than the profit from operations in 2021. But we are only given the information regarding profit for the year 2021, which is 36,000. And we also know that the long-term loan or the non-current liabilities was only debenture for the year 2021, which means that the finance cost for the year 2021 is also only related to the interest payment of debentures. So this means that we can easily figure out the profit from operations for the year 2021 by adjusting the finance cost to the profit for the year. In order to do so, let's figure out the debenture cost for the year 2021. So we know that we have the debentures of 8%, which means that we need to pay an interest of 8% on this debenture of 50,000 every year. So the interest payment or the finance cost is just going to be 8% times the debenture amount of 50,000. So we can just write it as 0.08 times 50,000. All right, this gives our interest payment to be 4,000. So if we have the interest payment or finance cost and the profit for the year, then we can easily figure out the profit from operation, right? So let's do that. What we know is that profit for the year is just the difference between profit from operations and the interest payment. And all values for these three headings we are calculating for the year 2021. So for 2021, profit for the year is given right here to be 36,000. And for the year 2021, we figured out the interest payment to be 4,000. So we are just going to substitute these values and figure out the profit from operations for the year 2021. So profit for the year was 36,000. Then we have profit from operations. And the interest payment was 4,000. All right, so we can now easily figure out the profit from operations. And this is for 2021. So that's going to be 36,000 plus 4,000, which gives us the total value of 40,000. All right. Then if we have a look at the above information again, what we know is that the profit from operations in 2022 is 12% higher than that of profit from operations in 2021. So now we can easily figure out the profit from operations for the year 2022. So since this is increasing by 12%, we can just multiply the previous year's profit from operations by 1.12. This gives our profit from operations for the year 2022 to be 44,800. All right, now we need to maintain the policy on income gearing of 25%, which means that the maximum interest payment can only be the 25% of the profit from operations, right? So let's figure out the maximum interest payments for the year 2022. So that's just going to be 25% of 44,800. So we can write it as 0.25 times 44,800, which gives our maximum interest payment to be 11,200. Okay, now the thing to remember here is that we already had our existing non-current liability of 8% debentures for the year 2022 as well, because this debenture is due for repayment in 2031, which means that the interest payment for the year 2022 is also going to include the interest payment for this 8% debenture, which is 4,000, right? So out of the total maximum interest payment of 11,200, 4,000 is of our existing debenture, which means that the remaining amount can relate to the maximum interest paid for the bank loan, right? So the remaining amount is just going to be the difference between these two values. So that's 11,200 minus 4,000, which gives us 7,200 to be the interest on loan. Now we need to figure out the value of the bank loan. So we already have the interest, right? And we are also given the interest rate that the long-term bank loan is to be 10%. Right? So we can just turn this interest on loan of 7,200 to be 10% of the total value of the bank loan. So 10% of bank loan is the interest payment on loan, which we figured out to be 7,200. So we can just term it as 0.10 times the bank loan to be 7,200. Now we can easily figure out the bank loan. So the bank loan is just going to be 7,200 divided by 0.10. So the maximum value of the bank loan is to be 72,000, considering the policy on the income gearing of the maximum interest payment to be 25% of the profits from operations for the year 2022. Alright, this concludes our second part. Now we can move to the third one. We need to calculate the balance on the retained earnings account on 31st December 2022 if all the 100,000 needed is financed by the 10% bank loan. The rate of dividend cover should be maintained at 2021 level. Alright, so for this we can just include the retained earnings column from our statement of changes in equity. Alright, we always start with our opening balance, which is going to be the balance at 1st January 2022. Okay, let's have a look at the above statement of financial position in order to figure out this opening balance of retained earning. This is a financial position on 31st December 2021, which means that this will be the opening value for the year 2022. And we're talking about retained earnings, which has the value of 78,000. Let's substitute this value in our retained earnings statement. Now we know that retained earnings is going to include the profit for the year, right? So we need to add the profit for the year 2022 because we're talking about the retained earnings closing balance on 31st December 2022. Now what we know is that we already figured out the operating profit for the year 2022 in the above section. So let's have a look. So the profit from operations, we figured it out to be 44,800. Now in order to figure out our profit for the year, we just need to subtract our interest payments for the year 2022. And we know that debenture is still present for this particular year. So obviously the interest payment is going to include the 4,000 interest payment on the 8% debentures. Then we are given the additional information that the 100,000 needed is actually financed by 10% bank loan, which means that this is also a non-current liability on which we need to pay the interest rate of 10%. All right, so I'm just going to figure out the profit for the year 2022. We start with the profit from operations, which had the value of 44,800. Now we just keep subtracting our interest payments. So the first one is 4,000 for 8% debentures. Then we also need to pay 10% on this bank loan of 100,000. So that's just going to be 100,000 times 10. All right, so the profit for the year 2022 is just going to be 44,800 minus 4,000 minus 100,000 times 0.10, which gives the value to be 30,800. So we definitely need to add this profit for the year to our opening retained earnings balance. Let's write it down. Then the next thing to be included in the retained earnings is obviously dividend. So dividend paid reduces the balance on our retained earnings. So we're just going to subtract the dividend paid. And we're also given the information regarding dividend that the rate of dividend cover should be maintained at the 2021 level. Let's have a look at the above information. So we were given that the profit for the year for 2021 was expected to be 36,000 and the dividend to be paid was 18,000. So if we figure out the dividend ratio in respect of the profit for the year, that's just 18,000, which is the dividend paid, divided by the profit for the year of 36,000 times 100%. So this just gives 50%. So what we can deduce is that we pay 50% of the profit for the year as dividends. So we need to do the same for the year 2022. We already have the profit for the year, which amounts to 30,800. Then this means that the dividend should just be 50% of this amount. So that's 0.50 times the amount of profit for the year, which is 30,800. So this gives our dividend payment to be 15,400, which needs to be deducted from our statement of retained earnings. So I'm just going to write it in a bracket indicating that this needs to be subtracted. Now we can easily figure out the retained earnings balance on 31st December 2022. We can write it down as balance on 31st December 2022. We just need to total these three amounts. So that's going to be 78,000 plus 30,800 minus 15,400, which gives the value of 93,400. All right, this concludes the third part. Now we can move to the fourth one. We need to calculate to two decimal places on the basis that the full bank loan of 100,000 was taken. The gearing ratio on 31st December 2021 and 31st December 2022. Okay, so let's first write down the formula for gearing ratio. That is just going to be our non-current liabilities divided by the capital employed times 100%. So capital employed is just going to be our shareholders' equity plus the non-current liabilities. So we need to figure this ratio for 31st December 2021 and 31st December 2022. So for 31st December 2021, the information regarding the non-current liabilities. So for the year 31st December 2021, the information regarding non-current liabilities and capital employed are given in the above statement of financial position. Let's have a look. So the only non-current liability that we have for the year 2021 is the 8% debenture amounting to 50,000. Then for our shareholders' equity, that is going to include our ordinary share capital, share premium, and retained earnings, which is of 200,000, 50,000, and 78,000 respectively. So let's write it down. For non-current liabilities, that was 8% debenture of 50,000. Then for the shareholders' equity, we had ordinary share of 200,000. Then we had our share premium of 50,000. Then we have our retained earnings of 78,000. Then we also need to add our non-current liability of 50,000. All right, now we just need to multiply it with 100% in order to figure out the gearing ratio. So that's going to be 50,000 divided by 200,000 plus 50,000 plus 78,000 plus 50,000 times 100%, which gives the ratio to be 13.23%. Now we repeat the same process for 31st December 2022. Now, we do not have any statement of financial position that we can refer to, but we do know that there was an additional non-current liability of 100,000, which was the bank loan, right? So now the non-current liabilities for 2022 is going to be the debenture plus our bank loan of 100,000. Then for shareholders' equity, the ordinary share and the share premium is going to remain the same because there was no additional issuance of any shares. So that's 200,000 plus 50,000. But we know that the balance on the retained earnings have definitely changed because we prepared our statement of retained earnings in the third part of the question. Let's have a look at the balance on 31st December 2022, which we figured out to be 93,400. So this is the value we need to place in the year 2022 instead of the balance on the year 2021, which was 78,000. So let's write down the 93,400. Then we again need to add our non-current liabilities, which is 50,000 debenture and another 100,000 as the bank loan. So we just multiply it with 100%. Now the gearing ratio for 31st December 2022 is just going to be 50,000 plus 100,000 divided by 200,000 plus 50,000 plus 93,400 plus 50,000 plus 100,000 times 100%, which gives us the value of 30.40%. All right, this concludes our fourth part. Now we can move to the fifth one. We need to advise the directors whether or not the company should finance all of the expansion with the bank loan. We need to justify our answer. So we just figured out our gearing ratio. Let's write down the explanation on the basis of our gearing ratio. We can see that for the year 2021, the gearing ratio was 13.23%, which means that out of the capital employed, 13.23% was financed by our non-current liabilities. Whereas for the year 2022, we have the value of 30.40, which means that capital employed includes 30.40% of our non-current liabilities. So although the bank loan definitely increases the gearing ratio, the ratio, we can still term it as pretty low because 30.40% is pretty reasonable gearing ratio. Let's write it down. So bank loan increases gearing but the ratio still remains low. Then for the second part, we can definitely say that the bank loan does not dilute ownership, because if we had issued any other shares, then it might have definitely diluted the ownership of the existing shareholders. But bank loan does not affect our shareholders' equity in any way, so that definitely does not dilute ownership. Let's write it down. Bank loan does not dilute ownership. Then we figured out the maximum bank loan we should take in order to maintain our income gearing ratio right here. So the maximum bank loan was supposed to be 72,000, but we took out a bank loan of 100,000, which means that this would definitely not achieve the gearing target of 25%. We can write it down as well. So bank loan of 100,000 means that income gearing ratio target of 25% would not be achieved. Then we can say that the bank loan amounts to 100,000, right? So to take out that amount from bank, we definitely require some sort of collateral. Let's write that down as well. Bank loan might require some collateral. And we also know that the bank loan is a non-current liability, which means that it needs to be repaid in some future years. And it also needs to be repaid. Now let's compare the bank loan with the debenture. We can see that the bank loan has an interest rate of 10%, whereas the debenture has an interest rate of 8%. So maybe debentures could be issued instead of bank loan, which might have a lower interest rate, right? Let's write it down. Debentures could be issued instead of bank loan, which might have a lower interest rate than the bank loan. Okay, then we require this financing of 100,000 in order to buy a new premises. But instead of buying a new premise, we could also rent the new premises, right? So that's an option as well. Let's write it down. The directors could rent the new premises instead of buying it. Alright, considering the factors that we just wrote down, we need to now make a decision. So personally, I would advise the directors to finance all of the expansion with the bank loan. So let's write that decision clearly. The directors should finance all of the expansion with the bank loan. Alright, this concludes our fifth part as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.